Welcome back. We are getting you excerpts from the FICCI organized seminar on deepening India's bond markets, a crying need of the hour. Speakers from the industry included Stuart Milne of HSBC, Anshula Kant of SBI, Koushik Chatterjee of Tata Steel, Ramesh Subramaniam of TATA, and Pankaj Vaish of Citi. Well, first listen in to a slice of their thoughts.
The Indian corporate bond markets are very small given the size of the economy. If you exclude the financial issuers, you're talking about less than 3% of GDP, so it's a very, very small number. The big challenge I can see versus what we see elsewhere in Asia is the fact that Indian companies, by and large, are already heavily over-leveraged. And there's also a very heavy reliance upon debt of one form or another in terms of funding operations. So if you take, for example, the funding of Indian companies, here in India, something like 72% comes from bank debt, 18% comes from the corporate bond market, and 10% comes from the equity market. In Hong Kong, 80% of that requirement comes from the equity market. And in fact, the country in Asia Pacific which is closest to India is China, where 18%, almost double, is coming from the equity market. And that then feeds through into this problem of over-leverage. Over the last 10 years, the number of companies with leverage more than 200% has gone up something like 12 or 13 times in India. Leverage rate of four times plus in India, which is very, very high. So it's a slightly odd thing to say, but to develop the corporate bond market here, we need the companies to issue more equity, to actually reduce leverage, and that will help to create confidence in investors. Right now, investors are going for AAA, AA. It crowds out the lower-rated credits, which basically have to raise financing through the bank debt market. So I think this question of how do we get the confidence of investors that the paper they're buying is good quality paper, get the leverage balance right, and then the other things which are obviously important, things like credit rating agencies, bankruptcy code, all this infrastructure is very important. But fundamentally, it's the question of leverage and looking at the very high degree of leverage in India versus other emerging markets.
The issuances are restricted primarily to the financial sector. We run a concentration risk if we keep investing there. The other is, given that LCR is coming in and LCR is going to just go up year after year, these bonds are not LCR compliant. So the corporate bonds are LCR compliant with a haircut of 15% if they are above a certain rating. So these are some of the risks that we run. And obviously, as Mr. Joshi said, or as Pankaj said, if some of these instruments, if the bankruptcy code comes in, maybe the liquidity will improve. And of course, we do, as I think we all know, that we need some infrastructure there in terms of a screen-based order matching kind of a trading platform, which helps players to actually buy and sell more easily. Currently, if we have to do a repo, we have to get into a GMRA with each counterparty, which is very time consuming and it's not efficient. The price discovery is not efficient when it is a completely OTC driven market, private placement driven market. Very few primary issuances are actually on this exchange.
If I look at, for example, this rupee denominated masala bonds, we do not have liquidity in the market as of now. The question is, this market will not grow in the levels we desire if we keep tying it with strings. So if you really look at the bond market, you have to let go of the restrictions in some way or the other.
Which string?
Yeah, I'll come to that. So, for example, Pankaj talked about the tenure. So 3-year tenure or less, or more. So if you look around, I don't think many markets outside will have so much of tenure-based diktat that you can raise only 3.5 years plus, or you can't do the short end of the curve. Secondly, I think is the whole benchmark pricing issue. If your savings bank rates are on a different basis, Your bond market needs a benchmark. So it is either on a GOI security or a rupee OIS or whatever it is. But the savings bank rate is a very different orientation. We have got many bankers who often say this, because the money keeps going into the PPF and the VPFs and it doesn't hit the bank deposit. So there is a need to get the pricing structure of debt instrument in the country in one uniform manner, so that it is priced off effectively the same base. The third thing is, if you recall a couple of years back when the rupee jumped up to 869, a lot of companies were facing difficulties on the FCCBs, the convertible bonds. So if you were allowing a rupee denominated masala bond, what does it restrict in making it a convertible, rupee denominated convertible bond? So instrument choices, it just now says plain vanilla bond. So I think from a policy point of view, would you make the instrument choice for an issuer, or let the issuer and the investor determine which instrument works for that guy?
For good quality issuers, even the rating may not be a big constraint. You know, they can still manage. I see a huge problem in the second run, where there, as Stuart mentioned, over leverage is there. But I think that is where a IIFCL kind of institution can actually be designed to provide that fillip in between as a cushion to absorb some of the problems that the sector is going through. And I feel that it is a dual issue. One is push the supply side by the PFOs and the LICs of the world to more encouragingly participate, and also from the demand side ensure that there is good quality rating issuers which enter the market, because another few experiences bad, I think we will kill the market forever.
Just to highlight, I think in terms of the ecosystem, some of the things that are missing. One is you clearly need the big buyers, right? So you have the LIC, EPFO. As Mr. Joshi was also mentioning, some of the things that my team tells me is LIC and EPFO tend to be reluctant to buy premium securities. If they're trading above par, they tend to be reluctant. When we asked someone about that, they said there is an accounting issue. So you immediately eliminate a very large buyer from anything that's trading above 100 rupees to face value because of accounting ambiguity. I think that can be very easily cleared. Secondly, if they've not bought in a primary market, they generally are very reluctant to buy in the secondary market, because I think, again, internally a lot of questions are raised there. Why did you miss this there? Are there any reasons, any governance issues? Again, I think there's just too much suspicion and too much kind of not good reasons for some of this blockage. Even on the FII side, you need a full spectrum of buyers and sellers. I think it's a necessity. I think incentivize people to trade and churn, without which you will not have the ability to get two-way prices. FIIs have told us that, for example, this 3-year constraint that is there, we are, I think, starving our own companies who are not that highly credit rated, who cannot issue 5-year bonds, from getting that FII money.
Well, that's what the markets want. Here's my summary of their wish list. 1, removing the accounting problems that prevent LIC, EPFO from buying bonds that are quoting above par. 2, allowing organizations like LIC, EPFO to buy in the secondary market without always suspecting every trade. 3, more liberty for companies to switch dollar-denominated bonds into rupee bonds and vice versa. 4, smoothening the yield curve by removing discrepancies between savings bank rates and market rates, something which the Reserve Bank governor has been speaking about. 5, encouraging government-backed entities like, say, the IIFCL to provide takeout financing or credit enhancement, basically guaranteeing some part of bond losses. Yet, you must admit that these are all short-term fixes. Ultimately, Indian companies and the Indian government will have to de-lever, reduce their debt if bond markets have to develop. As Stuart Milne said, Indian bonds are not attractive because India's corporate sector is much more leveraged than their Asian counterparts. Also, as RBI's Kant said, deep bond markets will depend on the government lowering its fiscal deficit and a good bankruptcy law getting passed. Well, that's it on this edition of Indianomics. Thanks for watching.